Hello, everyone. This is Group 7. I'm Megan,
I'm Colby.
And I'm Kenny.
and we hope you enjoy our presentation.
We will be presenting to you today about Tesla and UPS, two very different companies as well as industries. After discussing each company's strategies and financials, we will let you know which company we have chosen and why.
All right, so the first company we're going to be presenting on is Tesla. Pictured here is their Model S, which retails at about $70,000. Moving on to the Porter's Five Forces. The automobile industry is an extremely cutthroat and competitive industry. With that said, however, Tesla is truly a pioneer within its own industry. Companies such as Porsche and BMW are beginning to produce 100% electric cars as well. That will definitely increase the competition. It is also difficult to enter into this industry because of the enormous initial investments required to purchase manufacturing plants and machinery. The only substitutes for Tesla would be walking or riding a bike or taking a bus in terms of daily transportation. Since cars are so convenient to everyday life, there's a very low risk that either of those activities would have an impact on Tesla. The bargaining power of buyers is low simply because the type of customers who purchase a Tesla are the wealthier class and aren't the type to bargain on price as much. That may change in the future with the release of the less expensive Model 3, but for now we give this a low risk. And lastly, the bargaining power of suppliers, we give a medium risk, simply because without Tesla's batteries, they are useless. But they're also building their own gigafactory in Nevada, which will be able to produce enormous amounts of batteries. For their competitive strategy, they definitely implement a differentiation strategy to compete within the industry. No other car manufacturer produces cars that have the same performance capability while being fully electric. For this reason, they're able to charge a premium price. In addition, they have their own charging stations with the recognizable Tesla logo. They have planted these in populated public areas, and you can also have one installed in your garage at home. Lastly, the Model 3, which was released a few weeks ago, is their first vehicle under the $40,000 mark. This will open their target market immensely. They'll be able to sell to a greater volume of customers.
Next, let's discuss some of the accounting policies, segment information, and executive compensation before diving into the financial calculations. For revenue recognition, the vehicle itself, plus any customer selected options and accessories, are recognized as soon as their revenue recognition criteria are met, which are listed on the slide. There are other specific elements that come with the vehicle that meet the definition of a deliverable under multiple element accounting guidance. These elements include free internet connectivity, free access to Tesla's supercharger network, and future over-the-air software updates. Free internet connectivity is recognized over the 4-year period it is offered to the customer. All other deliverables mentioned are recognized over the performance period, which is generally an 8-year life of the vehicle. Tesla uses the FIFO inventory valuation method. The inventory valuation is important in understanding the inventory number listed at the end of each year and how it affects the total current assets and total assets numbers. The inventory valuation is also considered for tax purposes. There were no off-balance sheet obligations listed in any of the most recent 5 years 10Ks for Tesla. Since vehicle sales require upfront payment before delivery, except for the finance portion, any accounts receivables that would be stated would come from other aspects, such as sales of powertrain systems and receivables from financial institutions. There was no amount listed for the allowance for bad debt, but they did state we provide an allowance against amounts receivable to the amount we reasonably believe will be collected. This statement is very vague, but considering their core operations leave no room for bad debt write-offs, This could justify not going into more detail on the subject of bad debt allowance. GM, however, offers their own financing. They have listed an allowance of 2.5%. We operate as one reportable segment, which is the design, development, manufacturing, and sales of electric vehicles, is how Tesla has announced its segment information. They do not consider the Model S and Model X as separate segments, but we did find some information on geographical segments. The US noticeably generates more revenue than any other country. Norway and China follow next, but contribute much less to the total revenue. For executive compensation, we will be discussing the salaries of the CEO of Tesla, Elon Musk, and the CEO of GM, Mary T. Barra. Executive compensation is based off of base salary, equity-based incentives, and other benefits such as health insurance and 401k. The base salary for Elon Musk is very low. In 2015, it was stated to be $37,440, and he only raised it by the California minimum wage requirements to $41,600 for 2016. Equity-based incentives, which are a majority of the total compensation, were granted in stocks and options back in 2012 and 2013. The total amount that has been issued to Elon is about 5.3 million shares and options combined, and is vested over the 10-year period he will serve. Calculated into a yearly salary, if all vested options are exercised, this would amount to just under $8 million per year. The most recent proxy notice stated that Elon has not exercised any of these stocks or options, however. For Mary T. Barra of GM, her base annual salary is much higher, at $1.6 million, and the total amount stated would be $14.4 million, but her realized amounts are about $4.5 million.
All right, looking at some income statements here for Tesla, you can see that they're losing money every year. With that said, however, their total revenue has doubled in the past 2 years. Stock price graph analysis. At the close of the most recent trading day, Tesla shares were trading at $254. From October 1st, 2013 to October 1st, 2015, the price of stock increased by nearly 20%. With the way things were trending and the Model 3 coming out, we don't expect this price to keep soaring. All right, some calculations. So first of all, equity is your skin in the game. A return on equity in the top left corner here is how much of a return you're getting on your investment. But let's take out some of the noise from net income and use operating. That tells us from your core part of the business, what percent are you getting back, which is a more clear picture than return on equity. Earnings per share, or EPS, tells us how much a company makes per share. Great way to compare different companies on a per share basis. Some more calculations. Free cash flow. It's a dollar amount found by subtracting capital expenditures from cash flow of operations. Another way of saying it is whether or not the company can sustain itself. Net profit margin is, tells us the percent of profit that actually makes it to the bottom line. Clearly, we want increasing numbers here. PE ratio analysis, this is very important. This is the price of stock divided by earnings per share. Higher numbers, higher risk. Industry average here is 13, so that means the stock price trades for 13 times annual earnings. Let's look at some ratios. Current ratio, simple. Current assets, current liabilities. Just comparing the two. Cash ignores AR and inventory. Cash over current liabilities tells us how liquid a company is. A quick ratio, if your inventory isn't worth much, how liquid is the company? This is also a clear picture of the liquidity. Operating cash flow ratio, how much cash does the company produce from its core business? And is that enough cash to pay off debt? Declining numbers means a company is less and less likely to pay off debt quickly. Increased numbers are good. Some more ratios. Liabilities to equity. is total liabilities over shareholders' equity. Pretty simple. Debt to equity explains how we're financing the business. Net debt to equity, net debt to equity is if we use all our cash to pay off debt and then take the remaining debt, we get an even clearer number here. Market to book determines value of company. Number over 1 is stock is undervalued. Less than 1, it's overvalued. All right, looking in the future here with some forecasting. You'll see on the left here our forecasted income statement. With the very bottom line, you'll see earnings per share at 1 penny. So this is what we look to see from Tesla in the next year.
All right, now we're going to move on to UPS. We're going to look at the Porter's 5 forces, and we believe that the rivalry among existing firms is medium to high. FedEx and USPS are the biggest competitors to UPS. When somebody orders something online, they typically don't care which company delivers the product. They're more concerned with getting the correct shipment when expected. There aren't switching costs if somebody chooses one company over another. And the threat of new entrants is low. This is because the enormous investment required and the difficulty to gain the economies of scale that UPS, FedEx, and USPS have established, both in and out of the US. If a new company were to try to enter this industry, they would be at a severe disadvantage going up against these giants. And we believe that the threat of substitute products is low. UPS has the capability to offer overnight and economy shipping, and there isn't really another means available that could deliver the same results in the same time frame. Power of buyers, we believe, is low because most of the times the actual cost of shipping isn't the main focus of a customer's purchase. Also, there isn't really an option of bargaining for the price for most customers who ship because the price is generally fixed. And bargaining power suppliers, we believe that this is medium. UPS has various suppliers for different aspects of its business. They don't own all of their trucks, airplanes, and equipment. And because of this, they rely on other companies for a lot of their main operations, and they wouldn't be able to function without them. Moving on to competitive strategy, we believe that UPS implements a cost leadership strategy, and they do this a couple of ways. Because the nature of the industry is such that switching costs for customers is low, this forces competing companies to provide the best service with the lowest prices. And because the shipping costs for companies isn't one of their main costs that they incur, they'll generally just go with whichever shipping company is cheapest. And over the past 15 years, UPS has strived to broaden its business and capabilities to more than just package delivery. And in 2015, they purchased Coyote Logistics, which is an asset-light trucking broker with several other specialized businesses. And this will allow UPS to expand even more their services and expertise, thus increasing customer satisfaction.
Next, let's discuss some accounting policy information before diving into the financial calculations. Revenue recognition is realized when a letter or package is delivered. Now that was easy. For UPS's core business, that is all the detail we will go into for revenue recognition. UPS uses a specific identification inventory valuation method, as inventories are recognized when purchased and expensed when used. Inventory valuation is important in realizing the current and total assets, as well as their tax obligation. No off-balance sheet debt was stated in any of the 5 most recent 10-Ks for UPS. The allowance for bad debt percentage for UPS is 1.65%, which is slightly higher than its competitor, as FedEx reports 1.53% allowance for bad debt. UPS is a definite leader in U.S. domestic sales. The segments UPS identifies are U.S. domestic package, international package, and supply chain and freight. Most of its revenues come from the U.S. domestic package segment. On an international level, over 3/4 of revenue, as segmented by geography, is U.S.-based, leaving us to realize that the international income is not nearly as important to UPS. The most recent stated total revenue for UPS in the 10K of 2015 is $58.4 billion, just to give you an idea of how these percentages pan out. For the executive compensation, we will be comparing the salaries of the CEOs of UPS and FedEx. The executive compensation is based off of base salary, annual incentive, and long-term performance-based equity. UPS's CEO, David P. Abney, made a reported $11.3 million in 2015, where $8.3 million is from stocks and options, just over $1 million is annual salary, and other cash incentives were calculated in there. Friedrich W. Smith, the CEO of FedEx, made even more. With a base salary of $1.3 million, his total compensation, including stock options, was $13.8 million.
Okay, now we're going to move on to the financials of UPS. A quick glance at the income statement. It just shows that the total revenue over the last few years has increased, not by a lot, but it has increased, and while the cost of revenue has even decreased. Stock price of UPS from October 2015 compared to October of 2013, the increase has been 6.88%, so that's definitely positive. Return on equity, as mentioned before, is basically the return from our business compared to the equity or the shareholder's skin in the game. Whereas the operating return on equity is a little bit clearer of a picture. It kind of reduces some of the noise. Basically compares the operating return of our business compared to the equity. And the earnings per share, we can see that compared to FedEx that we've been hanging in there. We've been pretty close with them. Free cash flow, basically this determines whether or not the cash flow from our operations is enough to cover our capital expenditures. It's a good indicator of whether or not we are going to be sustainable in the future. Net profit margin, this talks about what percent of profit actually makes it all the way to the bottom line. And the PE ratio, the industry average has been about 32.8. This is a multiple. This number is a multiple. Basically, the higher the number, the riskier the stock. Doesn't necessarily mean it's bad, but with a higher risk, we do expect to receive a higher return. Moving on to a couple other ratios. Current ratio, we're just looking at the current assets compared to the current liabilities. A number over 1 is ideal. Basically means we've got more assets than we do liabilities. As we move from current to cash to quick, what we're doing is we're eliminating some of the noise until we get to operating cash flow, which is ideal to do. We basically compare the operating cash flow without all the noise compared to the current liabilities. A few more ratios we've got here: liabilities to equity, debt to equity, and market to book, and net debt to equity. Basically, we're just comparing our liabilities to the shareholders' equity. This explains how basically talks about, like, debt to equity explains how we're financing our company or our business. And looking ahead at some of our numbers for 2016 with increased revenues and profits, we expect to have an earnings per share in line to be about $5.57.
So who do we choose? Although UPS has a much longer history and stronger financials, we have chosen to go with Tesla. Tesla is a true pioneer in the all-electric vehicle industry. This industry was literally not here 10 years ago and is still emerging. With the Model 3 recently being announced and the lower price point Tesla is offering with this new model, we feel the potential for Tesla is not anywhere near its peak. Thank you for watching our presentation.